that was watching back, and we'll take it away.
Good morning, everyone. Thank you so much for joining us. Bev, thank you. We know the morning thing's a little rough, but thanks for coming. For those of you who I don't know, my name is Stacy Crawford, and I'm the president and CEO of the Community Foundation. We're really happy to have this morning. You know, professional advisors are such a great resource for us here at the Community Foundation, and we've built so many relationships with the clients that they serve. We work with our advisors often, and this idea of professional advisor network came about. Karen, our marketing committee chair, wanted us to make sure we're extending our mission and helping our professional advisors with the information and strategies that can help benefit your clients that pertain to charitable giving. So connecting with your clients and the latest information on how they can support the causes they care deeply about makes you and us look like rock stars and good stewards of our community's resources. So as we get started here, I want to introduce Bev Stitely. She's the managing partner and owner of Saunders Tax Accounting, located right here in Hagerstown. And in her current role since 2008, Bev is committed to ensuring a positive business experience. She sets the standards for tax expertise since beginning in the industry back in 1991. And she enjoys sharing her passion with her staff, as well as various businesses and community organizations that have requested her as a public speaker. And we are so happy that she agreed to get up early on the morning during tax season and do this for us. So I'm going to turn it over to Bev, and thank you everyone for joining us.
Oh, thank you very much. I appreciate it. And I appreciate the opportunity to talk about charitable giving. This is something near and dear to my heart, and truly a lot of the benefit of doing tax planning with clients is now they have more disposable income to do things such as charitable giving with, or maybe any other dreams that they may have. So we're going to talk about some of the tax benefits from charitable giving. I come from the tax side of the world. I am a tax geek, and I was crowned several years ago from my office as the tax queen. My ideal job would be just to sit back and answer all the tax questions. So I'd love doing that. So how about for you? What can you do for your clients to benefit them while benefiting others? And a lot of our clients really are interested in that. So we're going to set some basic ground rules about charitable giving, and we are going to talk about some of the simplest types of charitable giving to start with and build up to the more complicated, so getting us going. So first off, charitable giving has to be an acceptable charitable organization. So something recognized by IRS that is operates exclusively for the benefit such as religious, educational, public safety, literary, education would all be public charities and or a private foundation. Charitable giving does not include gifts to individuals. So that is not only family members, which sometimes I have clients that want to tell me how much they've given their children, but also when you see that we want to help so-and-so because there was a fire in the home or something like that. And that's a great thing to help with. But that is not a charitable gift. It is not an organization. I had a client tell me that their CPA told them if they wrote a check to the pastor of the church, as long as they put the word reverend in front of it, it made it a charitable donation. That is incorrect, regardless of what title you put on that. He is still an individual. The church is the charitable organization, so that makes a difference. Political organizations, political campaigns are not charitable organizations. Your local fire company, that membership that you get is not a charitable donation. Something above that would be, but not that membership, something that gives you the right to have something. And raffle tickets sold by a nonprofit are not charitable gifts. You have gotten what you paid for, a chance to win something. So bingos and raffles, not charitable donations. So the kinds of things that people ask me during tax time. Charitable giving as for tax deductibility falls under the itemized deductions. And just to remind you, in 2017, in the small box is what the standard deductions were for the different filing statuses. And the Tax Cut and Jobs Act of 2017 just about doubled all the standard deductions. And so you see those in the big box, what they are for 2022 coming forward here. And so it has gotten harder for people to itemize and take advantage of the charitable donation unless they have a good bit. Back in 2017, we had 3 out of 10 clients would itemize. And now here in 2022, I have 1 out of 10 clients that will itemize because that standard deduction has been increased so much that it's made it more difficult for them. Oops, no, I do want to go that way. So charitable giving, cash, we will use the word cash, including cash, check, credit cards. Those gifts can be given to an organization. You have to have a receipt from the organization or banking records such as canceled checks or credit card records. There is no more estimating how much I put into the Sunday offering plate in cash. You must be able to back up every dollar of cash contributions you claim on your tax return. That includes the money that you put into the Salvation Army Red Kettle at Christmas time. Those bell ringers do have receipt books in their pocket and can give you a receipt for what you put in there, but there is no more estimating of just how much cash I put in. If I give a gift of $250 or more to an organization within a 24-hour period, so you can't get around this rule just by doing 2 separate checks. In a 24-hour period, they must give you a specific receipt for that donation. An acknowledgement letter has to include the date, the amount, and if you received any benefit from the charitable organization. So you must have those receipts. Your year-end giving receipt will also include that total, but you must have a separate acknowledgement letter for any gift over $250. Now, part of getting around a little bit of the charitable issues, because I know some organizations have had a little bit more trouble since the changes in the tax law came to place. Last year, they added above the line deduction. So in that adjustments to income section of your tax return, a charitable contribution for cash contributions, cash, check, credit card, of $300. And for 2021, the taxes we are currently working on, it is $300 for a single or head of household and $600 for a married filing joint couple. So letting us take a little bit of that charitable donation, even if we are not able to itemize. Of course, you can itemize, you can take much, much more. Non-cash contributions, such as personal property. So the most common thing we think of as non-cash contributions when we're thinking of charity, we are thinking of those cleaning out the closets and taking things down to Goodwill or the mission. And that does count. Those are non-cash items that you're giving that are personal property. Personal property is anything that is not land or buildings. It has to be able to be tangible, be able to be seen or touched. Mobile homes, portable buildings, and the like are considered personal property. Here in the state of Maryland, they're tagged as vehicles. So they would fall under the personal property items. Also, personal property items would include artwork, jewelry, collectibles, motor vehicles, business inventory or equipment. Some transfers are going to require an appraisal of the item based on the dollar amount. And if we're talking about a motor vehicle, also boats and airplanes fall into this category. You can't exceed, your deduction cannot exceed the gross proceeds from the sale of the item by the charity. So you'll get a special receipt from the charitable organization, an IRS form that tells you how much they were able to sell it for. So it's no longer just looking up what you think the blue book value of your vehicle is and claiming that amount. If the charity turns around and sells it, they must provide you with the receipt and show you the proceeds that they got for that item. Now, if they keep the vehicle to use in their charitable purpose, then you can use the blue book value of that, but you have to have that special receipt as part of your tax return. Clothing and qualifying household items, you can deduct the fair market value of food, clothing, household items such as furniture, linens, appliances, electronics. The items must be donated in new or used, can be new or used, but they must be in good condition. If you're giving something that is less than good condition, you're going to need to have an appraisal of it if you're trying to take more than $500. $500 is also the limit on the tax return where you can just put it on the line or you have to do a separate form. And if it is over $5,000 in good condition, you're still going to need an appraisal for those household type items, or artwork over $20,000 need to have an appraisal. So the charitable gift form on the tax return actually has a place for an appraiser to sign off on it. I've never had an appraiser use that. They have their own appraisal statement, and we attach that with the tax return when we have these large contributions of items. There's also some great software out there called It's Deductible for people to use for those non-cash items. It searches auction websites for values of items, and they will guarantee their value standing up in an IRS audit. So if you were doing something like moving, and so you're clearing a lot of things out, it would well be worth the 30 or 40 bucks that the software costs to get that software for the year and use that for your non-cash items that are just those normal things. Ordinary income property would be anything that if you sold it, the proceeds would be treated as ordinary incomes. The most common thing we think of with this would be some type of asset that we've owned for less than 1 year, so it does not qualify for capital gains treatment. It just qualifies for ordinary income treatment if you had sold it. So if you donate this to an organization, you get as a charitable contribution your basis in it. So what you paid for it. Let me explain just a little bit about basis, because there's a couple things that I always want people to keep in mind about basis. It makes a difference how you got the item, and this is for ordinary and long-term capital gain. It makes a difference how you got the item. If you purchased the item, your starting basis is what you paid for the item. But if the item was gifted to you, your basis is what the donor's basis is. Whoever gifted that to you, the donor's basis. So I have a ring on. I don't know how well you guys can see this. This was actually a combination of the diamonds from a wedding ring and an engagement ring that my neighbor, who I helped take care of, they never had any children, she gave me before she had passed away. She actually put it in the will, but decided to give me before that because she was afraid it would get stolen off her fingers if she went to the hospital. So she gifted this to me. Now, she still had the original receipts from Melart when she bought this back in the 60s, and she paid $600 total for the 2 rings. This was appraised. She had it appraised a couple years before she had given it to me, and just the solitaire was appraising for insurance purposes, and so I know that's a little bit higher, for $17,000. Okay, so in the will, if I had inherited, if she did not give it to me beforehand and I had inherited, I would have as my basis the fair market value on her date of death, so what it was worth when she passed away, as my basis in this ring. Because she gave it to me before she passed away, my basis is her $600 basis that she purchased the ring for. Okay, so the difference in the basis between getting a gift and getting inheritance, that really becomes in play a lot for your clientele as they start talking about putting their kids on their deed for their property. So we record those deeds down at the courthouse for what, $1, $10? Because we don't want to pay all that transfer tax, right? So we've gifted them the house. Did we do a gift tax return? Because we're more than, I'm sure, the annual exclusion when you gift property. And now your kid's basis in that property is your basis, what you had paid for the property, plus any improvements that you made over time. And not the fair market value when you pass away. So many times I will have that adult child come in to get their taxes done, and they're going to say, I inherited mom's house. And so I need to always ask a couple more questions of, was your deed ever put onto the property while mom was still alive? Was your name ever put onto the deed while your mom was still alive? And they will tell me yes. I said, okay, so you didn't inherit the property. She gifted you the property. So your basis, because now that you're ready to sell the property, is what mom's basis was in the property, and not the fair market value on her date of death. So there can be reasons, especially for planning for nursing home and et cetera, that people do that thing, and that will make the most sense for mom and dad, but that doesn't always make the most sense for the adult child that's getting the property. Now, having said that, the adult child never paid for this property, and so I don't feel really bad for them of making a $300,000 profit and them having to pay some tax on it, because they never put any money out in it anyway. So, but just understanding the difference in the basis. So ordinary income items is the basis of the property, not the fair market value. Real property, so real estate, these can also be used as a gift to a charitable organization. That includes the land and the structure that is on them. So all of those can be given to a nonprofit. So if you own this for more than 1 year, it is your fair market value at the date of giving the gift. You want to really watch the timing of that. So depending on the client and what their income levels are at, they want to pay attention to this. So I had a client that came to me after they had done this. They had not been a client of mine beforehand. They came to me after this was done and were new clients. So they had a property that they were not able to sell. This had been back a while ago, and they decided to give it to their church instead and let them hold it and sell it at some point, which is lovely, and benefit the church. So they felt they could take a contribution of the $250,000, which is what the home was worth at the time, and take that as a charitable donation. Well, they can, except you hit some income limits when we do charitable donations. And in their case, where they had retired after this and their income had dropped, they were not able to ever use up the amount of that contribution because you have 5 years to use it up. And so a better strategy would have been, thinking about this beforehand, if this was going to be happening, maybe they gift the house to their kids. And because that is a related party, we have a certain amount of holding time the kids would have to do. And then the kids could gift the house to the church. The kids, younger and being in their prime income producing years, had enough income showing on a tax return that they could have used up that charitable contribution of $250,000 over the 5-year carry out that they could do. So planning those types of gifts and whether the benefit can happen. Now, either way, the church benefited, and we love that about it, but thinking about what you are giving. When you give real estate, you also can keep the remainder of the gift as a personal residence. It's called a life estate, giving a remainder interest. IRS has tables for how to value the remainder interest in a property. Does not need to be the primary residence, can still be a vacation home or something else, but they have then the right to that property for until they die. This also could be set up for a husband and wife joint life expectancy. When they retain the life estate, whoops, I'm sorry, guys, I just slid my screen. Yep, let me get that there. All right, lost my button. So they have the right to live in the property and the responsibility to maintain the property. So they will still do the real estate taxes, any maintenance that needs to be done, insurance, etc. They have the right for the rest of their life to the use of that property. And so I have seen clients that have done this type of thing. They've gone into a nursing home, but because they had the life estate, while they were in the nursing home, they were renting out the property, and that rental income went to the individual who had the life estate because that was still the right to the use of the property and that income coming from the property. So making sure that is understood clearly, that once mom and dad are out of the house doesn't mean that you now take over the house, because it is until their death that they still have the right to that property. As I said, IRS publishes tables that, based on the age when the gift is given, gives a percentage of the value of that life estate. So you, of course, if you're at 60 doing this, and if you're at 80 doing this, the 60-year-old will have a larger percentage of interest because it's expected they would have a longer time. So be careful when you sell real estate that has a retainer life estate on. That person with the life estate will need to sign off on it. And there's a certain amount of the proceeds that will go to that person and not to the deeded name of the person on the property. Another gift using land value is conservation easements. We have a lot of local farmers around here that have put the farmland into conservation easements. This is actually also an investment tool that we have seen over the past several years. Conservation easement businesses pop up, creating a partnership around the land that you can buy into a conservation easement. The charitable donation for a conservation easement is the difference between the value of the land with the potential for development and then the value of the land with no potential for development. Because that's usually what you're doing, is you're preserving the land so it can't be developed, to keep the natural habitat there. It is the loss of that value of the potential development that is the charitable donation. Okay. Now, what has happened, and you'll see this on the IRS's top 10 hit list, conservation easement syndicates are now on the top 10 hit list of IRS because they've gotten way too aggressive at valuing that amount of loss of use of the land when they do the development. And so they have kind of overplayed that hand, and IRS has started to audit them. Now the audits have started. IRS have said the nasty words about being on the top 10 hit list, the dirty dozen, I think is actually is what they call it, 12. And so people are starting to be scared off from these conservation easements. There have not been any that have made it through court cases that they have been eliminated. Again, I have a client that we were waiting on this. He had got notice from his partnership. He had done a conservation easement. They're always structured as a partnership, that they were being audited for 2019, which was the year before he became my client. And he wanted to go ahead and pay the taxes on it now. I said, you can't pay the taxes on it now. You don't know how much of the gift they're disallowing. And if you just send a random payment into IRS for your 2019 return, they'll just send it back to you. There's no way for them to keep the money. But so understand the conservation easements can be a great benefit. Like I said, a lot of the local farmers have done that. I have several clients that have done that with their local farms. And there's two parts to that. So first off, the reduction of basis of that conservation easement amount reduces your basis in the property. And so if you originally paid $400,000 for the farm and you have a conservation easement that the gift part is $300,000, you don't have a capital gain item because you have enough basis. You're just reducing your basis by that. But if your basis was only $200,000 in the farm, that's what you paid for it, and your conservation easement is $300,000, you've reduced your basis to zero, and that additional amount over zero, that $100,000, is long-term capital gain income that they have to pay taxes on. So that creates income on your tax return. But the gift of the conservation easement, that reduction of value of $300,000, is also a charitable contribution. And so you may have income on your return from the conservation easement, but you also will have the charitable contribution from the conservation easement. So it is an interesting play of the two. And our clients that are farmers that are doing that, they have a special exception to the limit of how much they can contribute in a year. And we'll talk about that in a minute. Other appreciated property of capital asset is, so this one you most commonly think of the securities, the stocks, bonds, jewelries, collectibles such as coins or stamp collections. They are, if they've been owned for more than 1 year, they get the capital asset treatment. And your charitable donation is the fair market value of the property when you give it to the charity. Okay, so we want to use those types of items in our charitable gifts. So instead of selling the item, selling the stock, and then giving the money to the charity, when you do that, you now have created a capital gain income item for yourself on your tax return as one item, and then the charitable contribution as the second item. If you gift them the asset itself, you avoid having to pay, claim that as income, and you get the charitable donation of the fair market value of the item that you contributed, what it was worth on the date of the contribution. So when you're talking about stocks and things, that's the way you want to get it. So a stock that has increased in value for you. And so you're trying to avoid claiming that income on your tax return. So giving the stock to the charitable organization avoids having to claim the income, and then I get the charitable contribution of the higher fair market value on the date that I contributed that. Okay. So a double win on those types of things. So limits that we were talking about. So this is going to get a little hairy. So let me just stay with me here for a second. So many years ago, when this first came into rules, we called certain organizations 50% charities, because I could give up to 50% of my adjusted gross income in the form of cash to these charities. So they're still called 50% charities, but the job cut, the Tax Cut and Jobs Act of 2017 changed the percentage that you could give of your adjusted gross income up to 60% of your income, but we still call them 50% charities. Okay, so it's the type of charity. So examples of 50% charities are churches, schools, hospitals, government entities, other nonprofit agencies organized for charitable, religious, education, scientific, or literary purposes. So I can give money to this organization, 60% of whatever my adjusted gross income I can take as a current deduction of charitable contribution here and this year. And any amount in excess over that, I have 5 years to use it up. I can carry it forward for 5 years. First in, first out. So I will always use the oldest carryover for my items. Now, if there are two 30% numbers in this calculation. First, if to a 50% organization, I give them something that is a capital gain item, I can only take 30%. But then there are also 30% organizations. So the examples of 30% organizations are veterans organizations, domestic fraternal sororities, nonprofit cemeteries, and certain private foundations. They are 30% organizations. So when I give them cash, I can only take 30% of my adjusted gross income. Then when I give a 50% organization, I give them non-cash items, that long-term capital gain item, I can only take 30% of my adjusted gross income. Okay, and then there's one more, there's 20%. So to a 30% organization, I give capital gain item, I can only take 20% of my adjusted gross income. So I put a little table in here to kind of put those all together. So they're called 50% organizations, but they get a 60% contribution limit for non-capital gain items, and then 30% in 2 places and 20% in 1. Don't you like IRS making things simple? The other way to do charitable contributions is from your retirement account. So your IRA, simple IRA, an inherited IRA, a simple plan, a SEP plan, you can make a contribution from this directly to a charitable organization if you're at the point that you are now required to take your required minimum distribution. Now, the age on this used to be 70 and a half, but that was changed a couple of years ago in the Secure Act. That has now made it 72 before we need to take our required minimum distributions. So you have to be of that age bracket, and your required minimum distribution does not need to come to you. That amount and more, if you would like, can go to your charitable organization. Now, the benefit of that is that income never has to touch your tax return. So again, if you took it in and then you wrote a check to the charitable organization, you'd have to claim that required minimum distribution as income, and then which increases your adjusted gross income. And so now when I'm hitting my limits of paying out, I've changed my adjusted gross income. It also can increase the amount of your Social Security that is taxable, your AGI on your tax return when you're in this age bracket. That determines how much you're going to pay for your Medicare insurance, not this year, but the year after, because they will look back 2 years to see what your income was to determine how much Medicare insurance you are going to need to pay. And so getting this just totally out of your income and doing the charitable contribution straight from that means I get no income on my tax return, but no charitable donation either. I've let it bypass. It's like doing the charitable donation off the top. So there's a better way for you, but just understanding that. The maximum is $100,000 in a year. You can't do more than that. And we like the qualified charitable donations. Estate planning. So we're going to talk about a couple of things here that really have to do with doing some estate planning. Have lots of clients. Saunders has been around for a long time here in Washington County. They've been around 40 years, and I will have clients that talk to me about setting at Nancy Saunders' kitchen table to get their taxes done. By the way, Nancy's the original founder of the company, still works for us. She is a tax geek too. And so she comes in every year during tax season and does her 300 clients or so. And just, it's like old home week catching up with her, but a lot of them will stop by my office and reminisce about being at the different places Nancy had been and sitting at her kitchen table getting their taxes done. So estate planning, a few years ago when the Tax Cut and Jobs Act came out, we all thought, all right, we're going to be fine with estate planning because now for 2022, the limit is $12,060,000 per individual. For a married couple, it would be double that because they would each get that amount that they can exclude, they have that exemption for, before they start actually paying estate taxes. And so if I'm only going to have $6 million of value at the end of my life, I don't have to worry about estate taxes, right? Except it's going to change. So all of the Tax Cut and Jobs Act items expire at the end of 25. So in 26, we go back to all the old rules. So for example, think back to that standard deduction table that I showed you. Standard deductions go back down to what they had been previously. So again, we're back to itemizing again in 25. Now, that's if nothing else happens before that. So part of the Build Back Better plan that was proposed and was very close to passing this year from the Senate was to revert the estate tax level back to the pre-2018 level of $5 million. So that didn't pass. Wouldn't be surprised to see some of the things that were in the Build Back Better bill come back in smaller chunks instead of being such a large bill. But even if nothing happens, the way the law is set, everything under that Tax Cut and Jobs Act expires at the end of 25, and in 26, we have back to the old rules. So all the tax cuts, because every single tax bracket except the lowest 10% bracket was reduced by that bill. And so in 2026, everybody's taxes go up. The tax rates will go back up to what they had been previous. Standard deduction comes back to that amount. We lose the child tax credit and we get the exemptions for our kids back. There's lots of things that will change back that we've gotten used to already. So another good planning tip for clients is thinking about, now I still have a couple of years of lower tax rates. What kind of income do I want to be putting into my taxable income? For example, I have several clients that are converting traditional IRAs over to Roth IRAs between now and 26, getting that tax money paid on it now at the lower rate instead of in 26, especially if they expect their income not to reduce as they head into retirement years. Some people's income will not reduce based on how their income is set up. So just knowing that our estate tax right now is very high, the limit that we have before we need to start paying estate tax, but in 26 we'll drop back down. The state tax rate is 40%. And so that can be quite a chunk that they're taking from the what you want to be leaving to your family. So a lot of people are trying to get around things running through their estate. And so there are many different options for that. So a lot of charitable trust planning can happen with that. So if you have charities that you want to be benefiting, you can do that several ways with several different types of charitable trusts and doing some planning. So each one has their own pluses and minuses, and I'm going to run through an overview of them. We won't have time to get into the details, but these charitable gifts are all intra vitreous, which are gifts made while the donor is alive. A lifetime gift reduces the taxable estate and provides the charitable donation to the donor. So there are charitable lead trusts. And so you could have a charitable lead annuity trust, a CLAT, a charitable lead unit trust, a CLOT. And so those are the amounts that are given over the years of the trust are given to the charity from the funds. And so the donation to the charity is happening over a number of years. So depending on how you set up the trust, what type of number of years that is, and then whatever is left of that trust goes to your designated beneficiaries that are set up in that trust. A charitable remainder trust, which again, a charitable remainder annuity, a CRAT, or a charitable remainder unit trust, a CRUT, don't you love these names, are the opposite. So they can produce income to either you, the donor, or in tax terms, they call you the grantor, or they can be producing income for a non-grantor, so to your beneficiaries, and then the charity gets the remainder at the end of what is left in that trust at either the end of a certain number of years or at the end of your life, or a joint life with the spouse. They get the money at the end of it. So those are 4 general types of trust. There are a couple of deviations to all of these, but that is the idea of the 2 different types of trust that you can do. You can also have donor advised funds, which I'm sure the Community Foundation does several of these, which you're not actually controlling the funds, but you are advising on where you would like the funds to go to. And I believe in most cases, unless you do some strange request for your donor advised funds, these are usually honored for you. You also, if you have enough money, could set up a private foundation. We are all very familiar with the Bill Gates Foundation. So if you've got enough money, you can do things in that way. You can just do the old-fashioned testimonial giftable gifts. There are gifts that are made after the death of the donor, so such as charity directed by the will, an irrevocable testamentary trust for a charitable purposes, or you can give some flexibility and your spouse can choose to disclaim a gift that is supposed to pass, and then the contingent beneficiary could be the charitable. And so that allows the spouse the flexibility. If right now we think we have plenty of money, and at the point you pass away, there is plenty of money, your spouse could disclaim that gift and let it go on to charity because the spouse has other resources. But if it ends up that the other resources have gotten used up in some way, the spouse can then claim that gift and not pass it on to the charity. So those would be beneficial ways to looking at that. And that one gives a little bit of flexibility. We like that type. All right, so the lead trust, again, it is the lead amount, is the amount every year that is given to the charity. A grantor's charitable lead trust is you giving it, and that the income and expenses pass through to you as the grantor. You report them on your 1040 return. This is a revocable trust. And in the year you make the gift, the grantor is able to take the deduction for the present value of the cumulative payments to be received by the charity. A non-grantor charitable trust is somebody else is the beneficiary, and so that trust will do its own tax return, a 1041, claiming the income and expenses, so whatever that money is investing in. And again, within limits, the trust deducts its annual payments to the charity. We still have those income limits that we have to worry with. And then at the end of that time, the corpus or the principal is distributed to the family members or other third parties who are not the charity. The charity has gotten the money all along, and the remainder money goes to whoever you have set it up for. A charitable lead units, it can pay a variable amount each year. It allows the donor to gift variable annual payments to the charity for a period of time. You can use a fixed percentage payout to calculate the variable amount sent to the charity each year. Because the value of the investment within the trust fluctuates from year to year, a payment recalculates each year when you use a variable rate, and that's based on the new value of what goes out to the trust. So these are all lead. When you can fix the payment in advance, the year you set this trust up and fund it and start that ball rolling is when you take the deduction for the amount of future payments that are going to happen to that charitable organization. So lead one gives it to them over the years. As we said before, a charitable remainder trust gives the money at the end. And so the beneficiaries can be getting a stream of income for a period of years. And that stream of income can go to non-charitable beneficiaries. And you may also put charitable beneficiaries in there too if you want. But the idea is that the stream of income you're controlling while the trust is set up, and that stream can come off to your beneficiaries or even to yourself while you're still living. And then the remainder on the end is what distributes to the charity. The value of this, when you put this money into a charity, it bypasses that estate information, that estate value. So it's not going to go through probate, so you don't have to worry with the local probate stuff, and it is not going to go through estate taxes for you either. So it avoids those things. So if you have a client who's close to that 12 million amount, and as things increase in value with whatever they're investing over the next few years, may come over that. And again, looking at their age. So all that 12 million goes away in 2026 and goes to 5. And so do we want to get this out of their estate before that happens? And I'll get to that in just a second too, because there is guidance from IRS on that with when it changes over. Charitable remainder unit trust intended to provide a variable amount of income to a non-charitable beneficiary. They have to distribute at least 5% of the fair market value of the corpus each year, but the donor can set a higher percentage payout when the trust is established. So there does have to be a certain amount that is paid out, 5% is minimum. And that value can be adjusted annually with new income streams for the year, determining the basis and the value of the corp. So that is, again, another way with doing the remainder on the end. And you can have a remainder annuity trust. So using an annuity to do that, we can have either a fixed income. You can also have a variable annuity too. But the amount remains fixed once the initial payment is calculated. Therefore, that payment happens at the time the money goes into the trust. And we like those. No such thing as a good tax surprise. And I'm sorry, I thought I had put a slide on here. So let me just mention this. So we have I'm going to back up to the estate planning. We have the 12 million that we have currently. IRS regulations has clarified that people taking advantage of the increase base amount for the estate exemption of the 12,060,000 and making gifts during this time between 18 and 25 will not be harmed in 2025 when the amount is scheduled to drop back down. So say, for example, I go ahead and give away $9 million now, so, and I am under my 12,000, so I'm allowed to do that with no consequence. I will report. Understand, your clients have to report a gift that is over the annual amount, which is 16,000 for 2020, but they won't pay taxes on it until they've used up their 12,060,000. So I can go ahead and use up 9 million of that now. And when the rate drops, when the amount drops back down in 26, I will not have eliminated everything. I will not have to pay the tax on the difference. They will still recognize 9 million, what I gave, as my limit. And anything above that, then I'm going to pay a state tax on. But they won't go retroactively and try to claw the taxes, because I gave 9 million over my lifetime and I'm dying when 5 million is the limit. This does not give any reason for somebody to pull the plug on grandma at the end of 25. So we don't want to give that variable idea to them. Sorry about that. All right, so that's what I had to present to you this morning. I just want to give you a chance to get some questions together. And just remember, there is no such thing as a good tax surprise, whether it comes to the idea of planning for your estate and your charitable giving. Knowing your information in advance before you make a change is the best thing to do. So having a little bit of tax planning of what effect will this have. One of the saddest things that I ever have is somebody coming to me at this time of year to get their tax return done, and they did stuff last year and had no idea what effect that was going to have on them on their taxes. And now I have to give them a sad, sad tax bill that they wish they had known about in advance. So planning, no such thing as a good tax surprise.
Wally had asked a good question in the chat too, and I was curious, Wally, if you wanted to expand on your question, and Stephen answered also. It seems to relate to some of the tax law changes that are proposed about HR 1704. Wally, did you want to ask that to share?
Yeah, I wrote it. I'm actually talking to some legislators today. It's American Lions Museum Day, where we get to talk to our legislators, and we're talking about House Bill, what I wrote in there, 1704, Senate Bill 618. All the itemized for 2021 are done as of December 31st. So they're trying to increase it to 4,000 for 2022 only. And so I just wanted to double check if anybody else had heard that, because we're talking with some of our legislators here today for them to try to support that. And we've seen an uptick in nonprofit sectors of small giving because of the itemized deductions. And so we're trying to talk to our legislators about enhancing that and not keeping with the 17 tax cuts with that. So just double check and make sure people had heard that, or if they knew any more about it.
It hasn't gotten passed around a lot, especially things at the federal level. One of the organizations that I belong to that keep me up to date on tax issues will go down to the legislative level of what's just being proposed. So it hasn't gotten a whole lot of traction yet to be out there talking about it. What is very interesting, if you guys pay attention to what is going on in the Maryland state legislature, there is a ton of changes. Maryland has a surplus of income this year, and they are trying to give back. So there's a lot of subtractions to income. But one of the problems that we have had, Maryland has a really low standard deduction. And Maryland's law right now is that you can only itemize on your Maryland return if you itemized on your federal return. And one of the proposed changes is to break that you can do a standard on your federal and itemize on your Maryland, which could be very beneficial to folks, because they at least take the deduction over on their Maryland. Maryland standard deduction is like $3,000, $4,000. It's kind of an inflated a percentage amount in the middle there. So doing that one, but yeah, I really believe a lot of the things that we saw in the Build Back Better plan will come back in small parts. And I really think the emphasis of putting something to charity of that 3,000 and 6,000 that we've seen will start the momentum, and we will see more things be able to happen with that, even on the federal level. That is not one that's politically going to hurt anyone for voting on more charitable giving and letting us have a break for that. So that's an easy one that I think politicians can get behind. It'll just depend on what it gets connected with.
Now, one of the things out of the tax law, though, even though after 2025, the individuals go back pre-018, the corporations stay, though. They don't go back to pre-18, correct? So we work with a lot of corporate donations and folks. I think they stay at the levels they currently are. Is that correct, or am I wrong?
I believe they actually go back, but corporations, now again, they have a bigger revenue amount, but their percentage of charitable that they can deduct in the year is 10% of their income. So they have a lower percentage, but that's, 10% of a larger amount that they can do. But they, again, have the carryover. They can carry that gift over as they need to. And that would be for a C corporation. People that are an S corporation or a partnership, they are pass-through entities. And so that charitable contribution comes through and passes through to the shareholders and partners 1040 return. So they actually end up having the same thing. It's not a separate deduction for an S corporation or a partnership, but C corporations, it's an individual, it's the deduction for the corporation. Yeah. So the other thing that came out with the Tax Cut and Jobs Act for those partnerships and S corp was the qualified business income deduction, 20% of the profit from the business. That will disappear. And that's just it. The last time we had this large bill that had things that sunset was under President Bush. So all of those things went for 10 years. And then we started seeing extenders. They would extend it for another year. They extended this benefit for 2 years. They extended. And now we have that game that happens every year that we wait to see if IRS actually extends things like the educator expense or et cetera, that kind of stuff. So so they never completely go away. It would be so much easier if they didn't make these things sunset, but I understand the way politicians have to do numbers to make them balance to get a bill passed makes that difficult.
Any other questions from the group, or particularly about any of the tax law changes or expectations in future years?
Anything we can do to keep that adjusted gross income down will be beneficial to your clients too. So many other benefits on your tax return are based on that adjusted gross income. So that makes a marker. Then of course, if they're over $250,000 of income, they get the additional 3.6% on their investment income over anything over $250,000. So it's like another tax bump on that one too.
Thank you, Bev. We really appreciate this. And for those that are listening, Bev hit on a whole lot of really great things, all of which the Community Foundation can help with. And so we do annuities, we take in real property, we do appreciated stock. It was one of our biggest gifts last year, especially at the end of the year, and actually as we're seeing the beginning of this year. So we are here to help with all of those. We can set up remainder trusts. And again, part of that is the ability for us to then understand the donor intent, because again, the Community Foundation lives on donor intent. So we're here to help you. We really, really, really appreciate Bev coming. And on behalf of the Community Foundation, the Board of Trustees, I'd like to invite all of you to keep this conversation going. If you want to schedule a time to meet with me or any of our team to learn more, please just reach out. I think Tim's going to put my email in the chat. Our phone is here. If you're downtown, as spring comes and you're out and about, stop in. We're right across from Bulls and Bears. But we'd love to connect again and keep the conversation going. And again, Bev and Stephen, thank you so much for the early morning conversation. We really appreciate it. And everyone have a wonderful, maybe warm day.
Yeah. And pay attention to your emails too. For everyone that had registered, there'll be a complimentary e-gift card from River Bottom Roasters for $10. So thank you to them. And get a little perk later in the day or another day. And yeah, and anticipate many more of this too. We'd love to include your email addresses on future communications. And, as the world's reopening again too, we'll get together in person for this next one, hopefully. And yeah, just gather together and communicate. And like Stacey said, reach out to us and we'll welcome you into the office, or we'll go meet somewhere else and talk.
Take care, everyone.
All right. Thanks, everybody.
Thank you.
Have a great day.